Good morning, everyone, and welcome to our webinar, looking at the most recent advisor trends, both here and overseas. We'll look in depth today at some of the things keeping you, the advisor, up at night, including things like political risk, emigration of the next generation, and actually what the opportunities there are in these particularly unusual times, I think. I'm Georgina Smith, and it's my privilege to look after the INN8 distribution team. And it's great to see so many of our advisors online today, pretty much near enough 1,000 today. So thank you very much indeed for that. Quick note on CPD, we've applied for CPD accreditation, and this will be awarded automatically via an email following the webinar today. For those of you watching the recording, there will be questions following the webinar to enable you to claim CPD. As always, we're happy to take questions live via the Q&A section at the bottom of your screen, and we will do our best to answer them during and at the end of the session. So without further ado, I'd like to introduce you to Evan Bars. Evan is the partner at NMG and runs NMG Consulting South African operations across life insurance, wealth management and asset management. In addition, Evan has worked across NMG's Australian and UK offices and still remains involved in the UK operations, which allows us to give a really good comparison with the UK and, in fact, other emerging markets as well. Every year, Evan's team interviews hundreds of you. I'm sure some of you have joined today. And it's not just advisors. He interviews DFMs and asset managers across the whole spectrum of advice. In fact, there's not much he doesn't know about what's going on in our market. So welcome, Evan. Thank you very much for joining me today.
Great. Thanks, Georgina. And yeah, it's a tough one to follow. I'm sure there's bits that I don't know about, but we're happy to share the bits that we do. And also, as you say, there's hundreds we speak to, but I'm sure there's plenty of people on the call we don't. So that's my small pitch is please feel free to reach out if you do want to participate.
Absolutely. We've certainly got all the contact details for Evan, or pop it in the chat as well if you'd like to participate. It's really, really valuable insights that Evan is able to give to the market. So thank you very much to those of you who do participate. So Evan, if we're going to start today, and I'm going to take you back to sort of 6 years ago when you and I first met. Gosh, it feels like yesterday. I think you had only just left high school. I think looking at you, you still look very, very young to be doing what you're doing. But I think it was a great conversation that you and I had. And I remember you asked me a question and you said, George, what are the sort of questions that you want to know from advisors? And the first thing I said to you was, what keeps them up at night? I want to know what keeps them awake. And pretty much that's been a sticking question for every year for the last 6 years, more or less. So let's jump straight in there. What keeps advisors up at night, Evan?
Yeah, sure. And I think it's a key one, because until that point, we'd always just dove straight into what do you want your platform to do different, or what do you want your asset managers, but we never kind of got to what is the primary challenge that advisors are facing, and maybe it actually has that a component, but there's a bigger piece that they're really worried about. So unfortunately over the 6 years, it's been really consistent, right? And each year everyone's saying, well, right now the political environment must be worse, but actually over the 6 years, unfortunately, it's always been consistently political risk, geopolitical lately, but political risk, economy, the two of those making up more than half of all citations, and then things like business model concerns. So the first two being more kind of external environment, and then business model, which will be things like my succession plan, how do I get the next generation, or if they're going overseas, and also regulation, which I guess is a bit of a mix between internal and external. But those are the consistent ones, and there's one that's been actually new in the last year or so, which is a spike in affordability challenges, but the rest has been really consistent.
And that's interesting, that spike in affordability, because if you like, that's kind of the output of the input measure, which is the fact that we've had pretty much zero net flows, if you like, in South Africa, which is very different from other markets around the world. So yeah, the output measure is the fact that we've had zero net flows, but of course the resulting, the thing that feeds into the input measure is of course affordability. What do you think about that, Evan?
Yeah, and I mean, to your point, first on the net flows piece, we saw that, right? So I think it was around the first half of last year was the worst, but all through the quarters of last year, we did see very close to zero net flows. in the market. Interestingly, UK and these other markets did better. There's still net inflows, but it's still, I mean, the Fundscape Q3 report, they said this is the worst net flows we've ever had. So there's been consistently challenges around it. But the other piece that's interesting around the net flows and affordability piece in South Africa is that it's not isolated to a client segment. Even the high net worth advisors said 36% of their clients had affordability challenges. So I think you don't just win by participating at the moment. It is a tough environment. It's a net zero environment. So you need to make sure as an advisor, you're some shape or form ahead of the game. And maybe just the other thought on that affordability piece is that it's a challenge right now because we're finding, especially in the high net worth space, it's lifestyle versus longer term investments. And so we think the advisor's role is important in driving the right behavior. And the non-advised channel over the last couple of years, as soon as there's a challenge, we've seen that go into net outflow, because you can imagine without an advisor present, they're valuing their lifestyle over their longer term investments, which is probably not a shock. But so I think that's a key piece we've really found is around that advisor role in managing the affordability piece and making sure they're still investing and not just buying a new car.
And that's therein lies another opportunity, right? So the benefit that advisors are actually bringing to clients who are in that kind of that fear place, given the current economic conditions, that's surely a good news story for those advisors investing with new clients, being able to say, the trend actually is that I'm a lifestyle coach as much as a financial advisor, and I'm able to coach you for the long term rather than the short term. Would you agree?
Yeah, no, absolutely. I think it's the broader piece, and I'm sure we'll touch again on it later. It's the same thing we've seen in the UK is also there's the broader shift around, firstly, not being a product push, right? That not being the role of the advisor. Then the second piece is a little bit around advice process, but more focused on the advisor's advice process and how might a customer fit into it. And then I think the third piece is things you're talking about, which is how does the advisor fit around the customer and understand the customer a little bit better, and then link into things like you said, the lifestyle piece. So I'd agree. I'm sure we'll touch on it as well more.
Yeah, absolutely, and we'll definitely explore that a little bit later in terms of different client segments and how we can expand that out. But let's go back to some of the other stuff that's keeping people up at night. Number one, political instability. We hear that time and time again, and of course we're in an election year, so it's really coming to the fore. But some people say in the face of chaos there's opportunity. What are the behaviors that we're seeing as a result of this, and where are the opportunities, Evan?
Sure. And so, I mean, the very first piece on the political instability point, and I won't go into any political comments or get involved in any of that, but more just thinking about it from the advisor point of view and the industry point of view. I think what's interesting, and it's a weird parallel to draw, but we've just finished Q4 of last year. NMG did a bunch of interviews globally, but the market that I'm going to refer to here was actually a market that knows a bit around political instability, which is Latin America. So, between Brazil and Chile and whatever, we spoke to advisors in those markets. And interestingly, they did acknowledge it was obviously bad for the countries that they lived in, but they mentioned it was the best driver of new business for them as an advice firm. They said it is bad more broadly, but it is interesting because it gets cited as the number one challenge in SA. And obviously it is a challenge and a challenge for the country. But at the same time, we do think there's some truth in what the Latin American advisors are saying, which is that consumers are much less likely to think they can do it themselves when they look and see quite a chaotic environment, a lot of moving pieces, and they're much more likely to look for security and advice. So I guess it's to that point around also the net zero and affordability challenge environment. There's a lot of things that make us think the direct channel is not going to take over. And actually there's political instability links to that as well.
Yes. Sorry, carry on, Evan. Carry on.
No, sorry. I just realized I didn't even answer the second part of your question, right? So I just kind of addressed. But sorry, to go back, because I guess the second part of your question was around like what are we seeing and what are the opportunities there? I was just kind of commenting on that kind of broader problem statement. I think, look, the obvious piece that we really see come through, and advisors probably aren't going to be shocked about this, is offshore flows, so hard currency. So we've seen hard currency ramp up. The good news, though, and again, this is not true globally, is they're looking for South African advisors to help them place their money into hard currency offshore. Because in some countries, there'll be a preference for a local advisor. In some countries, there'll be a preference for one of these offshore firms, right? So, but they'll look for offshore placements. And so if an advisor's not on top of their game in terms of the offshore wrappers or the offshore investment landscape, like the fund managers, especially with things like the Reg 28 ramp up, if they're not on top of that, it's missing an opportunity. But it doesn't also mean that the advisors have to be on top of all the detail. We do see some partnerships, like say working with a DFM or another partner, right, to kind of be on top of that. But I think that's a key one: is the offshore landscape is the opportunity, and it's also a cost if you're not on top of it, I guess.
And in your view, are South African advisors, are we seeing more go offshore? I mean, obviously we've had challenges with the exchange rate recently, but given the chaos or the political state of affairs here, and the imminent election, what are we seeing in terms of flows going offshore from a South African perspective?
Sure. So the intentions are really high. I think you made the point there around the exchange rates. That's what was holding us back, I think, for a lot of last year. So that's where the DFM interviews, I think, were very helpful. Was DFMs were telling us the average number came to somewhere in the high 20s offshore. And well, there's a certain subset I'm referring to here, but they were saying about 29% currently, and the target was about 46. So longer term, there's this clear ramp up multiplicatively, right? The 46 on 29 is a proper ramp up in flows. The intention was there. But we were getting comments like, we don't time the market, but we know now's a bad time. So it's this interesting piece around, like, we're not generally trying to time it, but we're holding on. But the intention longer term is there, right? We think it's going to flow, and might even already be starting from the data that we're seeing.
And in my experience, Evan, what you tend to see is that, when the exchange rate moves significantly, there's this eternal optimism that it will drop back to where it was, and people are just waiting for that to happen. And it takes a little while for people's mindset to go, no, okay, 18 is the new norm. And until that sets in, both with advisors and clients, there's kind of a stall in offshore, regardless of what's going on from a political stability perspective. Would you agree with that?
Yeah, no, absolutely. Yeah, I think there's some hope, in the next few months, hopefully it comes back. And if it doesn't, I think over time there'll be acceptance, and then we're going to see it. But one way or another, the numbers were high in longer term. The numbers going to flow. It's just a question of when. It would be our view.
So what you're saying is, looking forward, there's definitely a trend towards offshore, not away from offshore. It's just not timing the market, but we are actually, but not really. Okay. Yeah. So you mentioned DFMs there, sure. And DFMs being a really important partner, and they've certainly seen a huge amount of growth in South Africa lately. How does that compare with what's going on in other markets from a DFM perspective?
Sure. So of all the markets that we work in, right, so I'm taking UK and Oz and these kind of key comparison markets, interestingly, often we think, or advisors come to us and think the UK is the future state of SA markets, whereas in a few things, including DFM growth and DFM penetration, SA is currently leading the UK. So it's grown very rapidly, but both markets are still growing. So it's not that kind of UK stopped growing and SA is growing. It's actually, they're both growing, but South Africa is currently leading. The challenge, though, is conversion rate, right? So the relationships are being established, but we're finding it maybe, I don't know the numbers you've seen, but I'm seeing somewhere in the kind of low 50s as the actual, I've got a relationship, how many of my assets are with them? But I think the piece there is really around, how do you connect the advice process to the solutions, rather than just seeing the DFM solutions as a bunch of new funds on your list. Instead, it's how do I link my advice process to those, and then the conversion comes over time, I guess.
Yeah, and it's almost like it's what I see is advisors really believe in a DFM. Those that partner with a DFM, they really want to get in bed with them. It's almost like it loses a bit of steam over time, and the CGT conversation is perhaps a little bit difficult. And then that last 50% of the book that just doesn't get converted just stays outside the model. So you end up actually with quite a complex business model. Perhaps even more complex than before you had a DFM, because you're trying to manage kind of clients that are in the DFM and clients that aren't in the DFM. Do you see that happening quite a lot?
Yeah, no, for sure. And it's also it's this interesting challenge playing throughout, because the advisor now it'll depend, right? There's always advisors, there can be some exceptions on some of these trends, but for a lot of advisors, if they're working with a DFM, they've kind of decided, well, you're my partner, so I'm going to come to you with all my problems and I need you to solve them. And so these are things that the DFMs probably didn't think was their job. But solving like succession plans, I'm sure we'll talk about that, but succession plans, client segmentation, or practice management questions more broadly. And so I guess they go hand in hand, because if the DFM's only looking at half the book and not really completely across it, then they're saying, well, to solve things like client segmentation for parts of the book we're not even involved in becomes harder. And for them, obviously, it's uplift for their revenue. So Um, yeah, I think it's definitely that challenge. How do they drive that up? How do you get more conversion? And then that'll link to the ability to answer some of these questions. But it is interesting because the DFMs in the UK did not get this part of the requirements, right? They were more the investment management portfolio construction piece, research, and less of the succession planning, for example.
Yeah, and certainly from reading your study, DFMs quickly followed by platforms, but DFMs tend to have a stronger relationship with the advisor simply because of the the closeness, the things that an advisor is actually asking the DFM to do. Is that the same elsewhere, Evan?
Yeah, less in other countries than in SA. So SA is definitely leading on that. I noticed you mentioned quickly followed by platform there. It is true. It is true. So we're finding, yeah, and I think the platform piece that we find a much higher variance, right? Some platforms are pigeonholed into your service provider, and then others, they're kind of more likely to value the views and see as a business partner. So there's more variance, but actually it is very close. I think it's like at most 1 point out of 10 or something difference, with asset managers being more likely to have been commoditized and disintermediated at the moment. But yeah, so the DFM is that role in partner. It is probably still the most likely in other markets, but it's more so here.
Yeah, and I find that also very interesting because that relationship between the advisor and the DFM, here there seems to be a huge amount of trust between the DFM and the advisor, whereas perhaps in other markets, DFMs have tried to have a direct relationship with the client, which absolutely isn't the model here. Would you agree?
Yeah. I think and look, it's not to attribute malice to those models in the UK either, because I think a lot of the time the DFMs came out of the more private client style share portfolios or full discretion management, stockbroking style thing, came out of that where they already had direct relationships. And then it evolved into the advisor DFM model we know nowadays. And I think in SA, we skipped that. The DFMs came straight to the advisor piece. And then it's a bit different. But yeah, I think to your point, the fact that the DFMs in SA are really focused on the advisors have to succeed and then we succeed does help them. Yeah, and I think that whole trust piece, the fact they're not disintermediating is a key part, right? Because fundamentally, there's got to be a level of trust, right?
Yeah, absolutely. And I mean, let's talk a little bit about that piece that comes up in the what keeps you up at night, that succession planning, because of course that's also really important for DFMs, right? Because not only is it important for the advisor to understand how he's going to exit, and I mean succession planning. Okay, there's a couple of pieces to succession planning. One is succession planning of clients and across multi-generational clients, but of course that builds value in your business. But actually, what a lot of people are struggling with is actually succession of my business. Like, how am I going to get out of this business and retire? I mean, we the average age of an advisor is somewhere within the 50s, and it's always been somewhere in the 50s in the wealth manager portion. But of course, there's more people in the value chain now that have an interest in what an advisor does in terms of exiting their world. And it's a big thing for DFMs, of course, because it's in their interest that those assets stay in the models, and especially given the prevalence of DFMs now in our market. What would you say to that, Evan?
Yeah, no, absolutely. And look, I think that's somewhere I don't want to get in trouble with the UK DFMs, but I think, look, hindsight's 2020, but that's something they missed, right? Is some of them, right? Is that they looked at this thing and said, look, we're not in the succession plan business. And then next thing if there's fewer advisors left, so now you've got fewer clients to work with, right? And so I think it's important pieces that, and again, so we're talking specifically DFMs here, but I think it extends to a lot of parts of the value chain, which is really if you're relying on the advisor to be dealing with the clients and you're really an extension of the advisor, which a few parts, and I would say platforms very similar, is you need the advisor to figure this thing out because they're your clients, and the less of them that stay around, the worse it is for the business. So I think that's definitely something that's important. And the good news is we've got the easy solution to all succession plans. No, I'm joking. It's the most, I think it's the hardest, and I think you alluded to it there, is even just the definition means different things to different people, different ages, different stages of their business. But it's a real topic of discussion right now, of course.
Yeah, I mean, you're so right. I mean, let's unpack that a little bit more. You know, you
Mm,
see hundreds of advisors, and there's all sorts
yeah.
of different ways in which an advisor can exit this industry, whether they go
Mm,
into partnership with someone else, they bring someone through in their own business, or they join a network, or all sorts of other ways. They sell their
yep.
book as a burning platform and off they go.
Yep. Yep. Yep.
But what they're all interested in is, how do I build value so that I can maximize the monetization of my book? How do I build as much value as possible out of
Yep.
my business so that I can exit
Mm,
in the best way possible? What
yep.
what are your thoughts on that?
Sure. And so I guess, well, so the building value piece, I think will, if I can, I'll take it one step back to who's going to see that value or who's going to value it. And I think, and you mentioned your examples there in the networks. I think it's also one worth flagging is that there's also channels that will will solve it within the channel itself. So in some cases, if you're a one man or woman band, you kind of have to do something to then have a succession plan. In some of the larger structures, you're probably going to have something internal increasingly built, but the piece around how much is it worth is key. Now, an interesting piece, now I'll talk specifically on IFA feedback here, and it's going to be more relevant to them, but I think the concept still relates to everyone, which is in the UK, when we asked advisors, and this will link, sorry, I'll link to your question in a sec, but when you ask
Yeah,
them,
no, it's fun.
who do you want to work with, right? If you're looking at a partner either to sell the book to or work for the next 20 years with or bring someone into the business, who do you want to work with on your succession plan? The advisor thinks there's someone that looks just like them, thinks just like them, with the exact same mindset, same ethics, and says, that's exactly who I want to sell it to. Now, let's say hypothetically they can find this person. There's still the problem is capital, right? But overwhelmingly, we found the intention or the ideal answer is let's find someone who looks just like me. In reality, what we're finding is access to capital to make the whole transaction work is a real issue. And then even with the capital, maybe it's a one times if it's an advisor to an advisor, whereas the larger structures are more likely to look longer term and say is a 3 times gross revenue multiple. We've even seen some 5 times. Interesting, the 3 is consistent across the two countries, the UK and SA. But so maybe the preference is a very similar looking firm, but if you can be paid 3-4 times more for another, we're generally seeing the latter. And so to that point on what makes the business valuable, so what makes it a 1 or a 3 or a 4 or a 5, some of that will link to the business acquiring, right? Because if they've got more money available, they can take a longer term view, they'll pay a bit more. But I think there's a bit around consistency in a well-run business. Some of the things we've touched on a little bit, right? So a clear advice process, client segmentation, the centralized investment proposition, right? If it feels like there's 500 clients with 500 different investment processes and it's all over the place, someone's going to look at that and say, well, that's a risk. But the other one that's also interestingly a risk is almost a victim of success is if you're one very impressive individual and everything relies on the advisor and everything's in your head and nothing's down and there's no processes down, it works great while you're still in the business, but someone acquiring is going to look at that and say that's a key man or woman risk, and we're not going to pay as much for that. So I guess, sorry to go, it's been a really long way in answering your question, but I think the key bit there is that it's got to be something beyond just the person and their own magic and their own impressiveness, and more around like some form of institutionalization and segmentation and that. And then finally, sorry, last bit is, and you touched on it earlier, but I think this links in also nicely. There could be an upside is if you figure out a bit around the succession plan, it also could help for things like that intergenerational wealth transfer and actually having someone else in the business to engage, let's say the children, or depends who you bring in, but having that kind of multiple levels of engagement for the broader family. Sorry, I'm going to take a breath now. I kind of went on for a while there.
There's loads to unpack there. I want to go back first of all to what I always think of as the good citizen way in which you can sell your business, which is to bring someone through, which is the first point you made. You bring
Yep.
someone through and they look like me, they smell like me, and isn't it great?
Yep.
And it's kind of the way in which I think the model way in which most advisors would love to sell their business,
Yep.
to bring this person through. Some of the challenges I've seen with that is that as an advisor ages, they become more risk averse. It's only
Yep.
natural. But of course, if they look to get someone like them through the door, that person is going to be naturally risky because they're going to be an entrepreneur, just like the advisor who's exiting. So you get this kind of this rub of people. And actually the ones that I've seen as successful are the guys who go after someone who's not like them, someone
Yes.
who's not a hunter, not actually an entrepreneur, because at this stage in the business, what they need is a farmer, someone who
Yeah,
can
yeah,
farm the families and the clients, and not necessarily hunt for new
yeah,
business. Have you seen successes in that way, and have you seen rubs in the challenges I've highlighted there, both
yeah,
in our market and in other markets?
yeah, yeah.
Have you got any stories of where it's worked and where it hasn't, when you've got this mismatch or match of
Mm, mm.
personalities?
Yeah, well, so I mean, an interesting anecdote is, so I was just thinking of, as you're mentioning some of that, and the kind of problem statement is, I'm thinking of someone I know who runs a business, a smallish one, maybe 5 employees, um, but was really trying to find an entrepreneur just like them, until I pointed out to them, I said, but you wouldn't have worked for you, right? So there's the challenge, which is that often when you're trying to find yourself, well, you've just left a business and started your own, and if you, then they're going to leave you and start their own, right? So I think to your point is, sometimes the idea of finding the exact replica, is it's tough. But yeah, it's been a real tough one. I think that bit around bringing in someone else and finding the exact model, I think starting point you've mentioned, which is it may not be exactly someone who looks exactly like you. And actually, there's probably a lot of benefits in making sure that they cover different areas where you're weaker, and then together you kind of broaden the proposition. But I think it's also one around thinking, where are the places that we can potentially find, like what might be the right fit? So someone who's done a certain level of training but might value a book that's already well established, as you say, like pharma, like these kind of things, is important. And then the other challenge we get a lot is someone who's not got kind of a very large firm, and then they're thinking, I'm going to take someone out of uni and I'm just going to bring them straight into the business. And unfortunately, typically we interview them 2 years later, and then they're saying millennials aren't loyal, and then they're gone, that kind of thing. And but that's a real challenge, right? Is finding someone, and if you're not used to training people up, it's to go from one person business to just training someone straight out of university could be quite tough. But yeah, so I think to your point, the different models and the kind of hunt or the entrepreneur and then some of the farmer piece, I think is a really interesting angle. Makes sense.
Yeah, and for me, that good citizen model, I think, is probably the hardest model to get right. And I know
Yeah.
a couple of firms who have done it and got it right, and I know quite a few firms who have got it really wrong and wasted 5-6 years on training the wrong individual who's just gone off and done their own thing afterwards, or thought that financial advice wasn't actually for them. So the other one I want to on, the second one you mentioned was about, when you're building value, making sure that it's not all about me. Hashtag all about me. so
Yeah.
so actually trying to make a brand out of your business, as opposed to a personal brand that sits around you. Again, another very difficult thing for entrepreneurs to do, because of course all of their success really comes from their hard work and what they've actually invested into the business. And now I need to make it not all about me, and I need to make it about a wider business, so that actually I can demonstrate to any potential buyer that if I leave, this thing just runs without me. There's processes in place that run without me. One of the ways in which I've seen that work very well is to make sure multiple advisors within the firm touch the client. Is that something you see happening more in the UK, and are you seeing it happen more in South Africa as well? What are the kind of trends around, seeing multiple different people in firms touching a client, so that it becomes a much more sort of general and holistic experience for the client, as opposed to a one-to-one advisor client relationship? What are you seeing around that, Evan?
Sure. And so I'm trying to recall something we could look into. I don't think the UK is necessarily miles ahead on this one. I feel like this is probably a similar one that I've seen across the markets, but we are starting to see, I think to your point, a little bit more of those touch points. And I'll make another comment, I think, around that broadening the brand away from one person, especially. But if we go all the way back to the point around, there's instability, there's affordability challenges, and we want a safe pair of hands, and that's what clients are looking for. The best way to demonstrate safe pair of hands is that there's multiple pairs of hands, right? And so I think that's where, and look, within the firm, but also we're finding they're more likely to get a non-threatening part of the value chain. So we talk like DFMs to come as well and chat. So I think the piece around more touch points is also healthy, not just with respect to extending the brand, but also with respect to that comfort, which is going to be driving it in times of instability and affordability challenges. So that's one. And yeah, so I think it makes sense. The other one is also, I think there's a lot of underlying like small steps, but the general concept of what's the way we do stuff as a firm? If you can explain that, then that's a good start. Whereas if you can't actually explain the way you do stuff, it's just somewhere in your head, then that makes it a little bit tougher. And so I'm sure, a term like elevator pitch, which is, in the process, I don't know how long elevators take, but I'm sure it varies. But in the time in an elevator, you've got to be able to explain the way your business operates. And I think for a lot of advisors, there's too much genius involved, or too much kind of their way of thinking involved. And that's hard to then say this is the way the firm does it. And if there's other people that join, you're going to have to explain it to them. Otherwise, you're going to end up with 3 advisors with all their own processes. And then you don't have a 3-advisor firm. You've got 3 kind of different people within one firm. And so just a point on the previous one that I was just thinking of was, I think around the training also is, and that idea of bringing in and training new to industry, and that is that, look, we see the insurers are doing it, right? The big 5 are the main ones, and a couple more so than others. Is others just, there's always an optimistic firm that says, like, we're going to do it now, and then they find out there's a lot associated with it, right? You've got to have the proper training processes. It's more than just like, this is how to select funds or whatever, or not. I think it's interesting bit where we haven't really seen other parts of the chain really get what it takes to train. And often it's this idea that we're going to do it, and then it crashes and burns at some point in the future. But
yeah, there's a lot to it, isn't there, Evan?
Yeah.
Absolutely. Yeah, there really is, and that's why the big insurance houses, I think, are very well placed to deliver that kind of value. Now, one of the last thing you mentioned was, which I think is a really interesting topic in terms of building value, is about interacting with the next generation.
Yep.
I think one of the really interesting surveys that I think Schroders ran it years ago, where they said interestingly, when wealth transfers to the next generation, somewhere in the region of about 85% of inheritors don't or remove themselves from the parents' advisor within 5 years. And in fact, the number's worse in America. And so I find that fascinating. So we're obviously missing a trick, not just in terms of sustainability of my business as an advisor, but also building value. I mean, if I was a potential acquirer of a business, to see that you've got fantastic relationships and you're making inroads into the next generation, that certainly makes your business more valuable. So it's kind of on 2 fronts that we're seeing that. What are you seeing in that intergenerational wealth relationship? Because the challenge around that is, well, they don't have any money and it's going to be work for nothing. Yeah. That's what a short-sighted advisor might say.
Sounds perfect for a farmer. If you can bring someone in who wants to farm a book, and I think that's the point, right? So it is a challenge. And I think without being too controversial, I think it's one thing to think you've got a great relationship with the whole family, but then you might have the kids to say, "We still my father or mother's advisor, and you chat to me 10 minutes a year, and that's not and then next thing they inherit the money, and actually you find out you didn't have such a strong relationship." So I think there's a bit around real looking at this thing and saying, do I actually have a proper relationship with the family? Am I having equal, or not equal, but at least meaningful conversations with each part? And look, that's again a challenge. UK, I think, is in a similar spot to SA. I think in the UK, what we've seen is there's a bunch of advisors who have said, I think we're still a while off of wealth transfer, but this is a great lead generation source, because it is really hard. You can't buy Google leads. You can try. I mean, some advisors, and I'm sure we could think of a couple already top of your head that do great on LinkedIn and actually have quite a big brand presence. But I think it's really hard. Whereas you've got a great lead generation source sitting there, which is dealing with the next gen of clients, and it may not pay off in the next year, but it is a longer term piece. As you say, it builds value. So yeah, I think it's something that we're seeing more and more considered over time in all of our discussions. Right?
Yeah, and it comes to that segmenting your book and having different propositions for different parts of your book, which is something you touched on earlier, Evan. Really understanding what different people want. In fact, I saw another report where it said in the UK, within the next 10 years, 60% of the UK wealth will be with women as the baby boomers die off and women inherit. Again, the same kind of stats sit around women in terms of movement away from the family advisor. Yeah, I see other information that tells me that very few advisors have a proposition for women, and directed towards women. Tell me, what are some of the things, and I'm probably well placed to answer this actually as a woman, but what are some of the things that women are demonstrating they want, which are different from perhaps the patriarch of the family would want?
Sure. So, okay, I'll comment on some, and then I'm going to throw a lot more of it back to you. But so I think so. So first piece, I think you raise a really good point. I saw the same report as well. It's a great one. So I I think you raised firstly the good point is the counter argument. We were just talking a lot about children, but actually, if advisors aren't yet dealing with the spouse as well, right? If we're not dealing at that level on both ends, then we're actually putting cart before the horse if we're talking about the children, because as you say, right, there's probably a first step in a lot of cases. And again, I would say the same thing when it's husband wife is, or partners, right? Is that think about am I really do I have really have a relationship, or am I just casually bringing them in once every now and then, and they still feel like it's actually that they may not be telling you to your face that there's not a real relationship, but you got to, I think, really think about it. Do you have one? And maybe it's someone else at your firm. If we're saying you got multiple people dealing with one person, then you definitely got multiple people dealing with two, right? In the way you engage. So I think there's that bit. The idea that they might want something else in terms of their investment, I think that makes a lot of sense. And we see it also with next gen. I think a lot of different client segments will have different views. And so before we go into the bit around what might they want different, I think starting point is, do advisors have a way to segment them at the start? Because in all of our interviews, so in SA and in UK, advisors tell us we segment our clients. Great. The problem is in South Africa, it was something like 90% of the segmentation was, do you make me money? Do you have a lot of money? Do you have a little bit of money? Do you have no money? And then that's the segmentation. But the challenge is that doesn't link to things like ESG, and it doesn't link to things that might be different in generations. And so that's the bit that the UK are doing more so, is thinking about those segments. Like, you mentioned now gender, right? But generational, the children, that's a big part. And that'll link to, as I mentioned earlier, it'll link to things like ESG that in the current dominant segment may just seem like it's completely irrelevant. And then you might see another segment pop up, and all of a sudden they're asking for different things. With respect to gender, unfortunately, that's not an area we've looked at enough detail. I don't know if you've read anything in the space, but the starting piece would be you can't understand a segment's views if you're not segmenting that group of clients.
Yeah, and I couldn't agree more. And then, of course, there's all the behavioral biases that come in to you as an advisor when you're sitting with that segment. I mean, I've also seen reports that women and the next generation have a higher propensity to use ESG funds. How does that sit with current trends in our advisor force, both here and in the UK, in terms of what they think of ESG funds? Is there a match, or is there not a match there?
So often this happens where in South Africa, you're saying, oh, everyone in the UK is loving ESG. We're getting the exact same answers. It's remarkable. I think it's maybe a couple of percentage difference, but the exact same answers from South African and UK clients, so being frank, look, institutional is a different space, but the comments from advisors in the market are predominantly, no one's asked me for this thing, right? So I'm not getting demand from my clients. And look, that'll link to the segmentation piece, right? They're saying, no one's asked me for this thing. And then we've seen a little spike in both markets, right? In UK and SA, we've seen a little spike in, we think it comes at the cost of performance, which I expect probably links more to specific products or themes playing out in the market, right? And whatever, right? But the key point is a little bit of concerns around whether it comes at the cost of something else. But the main one overwhelmingly was, no one's asked me for this thing. And so I think that's where it's not to say that everyone's going to immediately adopt it and make it all about their business. But if you know that there's a segment of clients where this is really important to them, you might think, actually, let me have it for backup so that I can really impress those guys when they ask me for it, right? As an example, right? So I think it's that idea. But look, right now, I'm not going to tell you the UK advisors love it. It's the exact same spot as the SA market, really.
I think that's fascinating, but I do think there's a mismatch in terms of the clients that perhaps are going to become more important in an advisor's life and what they want versus what an advisor at the moment, the trends we're seeing in terms of what advisors actually think is going to deliver good returns for them. So quite interesting conversations to come up there. And tell me, Evan, so we talked about intergenerational wealth transfer, and one of the things that often comes up particularly in South Africa, is this this fear of the next generation, the children of my current clients emigrating, and what should I do about it? How should I combat that? What is there anything I can do, or should I just throw up my hands and just accept it?
Yeah, look, that's the toughest one you've asked me today. So that's the toughest one because we just haven't seen obvious solutions. And if we do, by the way, I'll send and we can send it around to everyone on this call. So we see ideas. It'll depend on the size of the firm as well, right? So larger firms are going to be better placed to establish an offshore office to continue it in that. But so firstly, yes, I would agree. There's a lot of that comes up a lot. We do see some firms expand operations. I think the starting point, though, is the good news is we still find that the SA advisor remains overwhelmingly relevant a lot of the time. Like maybe not in 20, 30 years of them being out of SA, but for a lot of that initial period, we find the SA advisor is still highly, highly relevant. You don't just land in another country and all of a sudden your wealth and everything in SA becomes irrelevant. We still find there's relevance. We do see some partnership plays. It's generally more of a defensive strategy, like don't take all the existing assets away and we'll have some form of partnership. But again, so yeah, look, we're going to keep asking and seeing if there's any firms that really figure it out, and I'll report back. But at the moment, it seems like a key challenge. Maybe I can buy myself some time again by saying it's probably going to be between partners first. So maybe there's that kind of initial piece. Yeah. But yeah, this is one. It's a key question. It's just no obvious answer, I think, at the moment.
It's interesting. So something that I've picked up in speaking to advisors in the UK. And I think it's actually an opportunity for South African advisors, particularly, is when this is an issue not just in SA, although we tend to think it is an issue just here, but in the UK you see a lot of the next generation emigrating to various parts of the world as well. But what you actually see in the UK is they're going to lots of different places, anywhere from Hong Kong to India to Australia to America to Eastern Europe to everywhere. So there's no real rhyme or reason behind where they go. Whereas actually in South Africa, it's kind of a rite of passage for someone leaving university to go to England, Australia, UK, Australia, or Canada. They tend to be those three places. So I think there is an opportunity to form partnerships in those three markets, which is a lot easier than it perhaps would be for a UK advisor. And I've come across UK advisors who've made partnerships with people in Spain, with other advisors in Spain, which obviously you've got a language barrier as well there. Same, with advisors in India. I mean, that feels like a very different, both of those feel like a very different cultural way of doing business, whereas actually for South African advisors, to partner with someone in Canada or in the UK or in Australia feels like quite a close match of values compared with perhaps what other markets are potentially challenged with. I don't know whether you would agree with that.
Yeah, no, I hadn't thought of that actually. In that, UK, you basically have to look at every country in the world that's got better weather, and you have to have a partnership all over, right? So, whereas in South Africa, I think the three you mentioned will be the vast majority of those. So yeah, I think you're right, and I think and a lot of the time, like some firms might even already be operating across some of those, and then you partner with one, and it gets you a couple. Yeah, so I think you're right. That's it's an advantage of the SA version is that actually it might be fewer partnerships and closer cultural alignment and regulatory alignment, right? Canada actually the less of them, but still, regulatory alignment is key.
Yeah, it's a very good point, Evan. So yeah, I think it's a thing that's happening. I think we have to accept it. Very few advisor firms have actually got it right in terms of working and opening a branch overseas and sitting in a different regulatory jurisdiction and actually making that work. The way I have seen it work is where some advisors have partnered to try to retain the assets that are in South Africa. And actually go with a partnership, particularly when there's assets here and then the client starts to accumulate assets overseas as well. Very often, we are seeing people come back, and the two places where clients tend to come back is when they have children and when they retire. They're the two kind of pinch points where people come back, I think. So it's interesting to see that. Okay, good. So there's all sorts of different ways I think we've explored in how you can build value in your practice, how you can
Mm.
think differently about segmenting your book. It's not about, band of income.
Yeah.
It as much about, different types of people who have different types of needs, and making sure that the brand is bigger than you. Now we've talked about trends in advice and with advisors and DFMs. But given the current market conditions, what trends are you seeing from a product perspective as well, Evan?
Sure. So the main one, okay, so when I talked earlier about trying to stop your clients from just taking all their money out because of affordability challenges, so on the accumulation side, the discretionary business generally been a little bit tougher, right? It's been a bit of outflow there because it's easier to just grab in some cases, and it's less locked in. But the main one actually has been decumulation. So we've seen with interest rates rising, we saw a massive spike. I think it's the quarter we most recently presented was something like an 86 or somewhere between 60 and 80 over the last few quarters has been the growth rate of guaranteed annuities or life annuities, right? And so we've seen massive shifts up to the point where it's for providers that offer both living annuity and life annuities, it's become the majority of their decumulation, right? Their retirement piece, which hasn't always been the historical norm. And I think it is an interesting piece. It's interest rates probably not going to be that high forever. There's going to be a kind of cyclical piece to it, but I think it gives rise to a question, which is something we've seen in the UK, where what is the right retirement advice process? It links to things like holistic advice. It was driven in the UK by DB transfers and pension consolidation and pension freedom and all of that. But advisors thought, hey, actually, let's make retirement advice part of my proposition. And it brought in these things like your living annuities or hybrids and your guaranteed components, and then for some clients, maybe I'm going to guarantee X amount. Maybe I'm then going to have the more exciting bit is going to be this amount. And I think that's going to be one that's going to shape, the decumulation or the retirement landscape over the next kind of decade or so in SA.
I think you're right, and it's how it's being packaged to clients as well. It's that this is, this is going to cover your fixed costs, and it's we know how much you spend in fixed costs, and therefore you're covered in your fixed costs. Therefore, with this other piece, I can be more exciting. It can be more exciting for you. We can take a few more risks with it. Whatever it is that however you do your investment process. But I think what's really interesting is that packaging of it to clients rather than just almost like two separate ways of decumulating. I think that's a very interesting development I think we've seen over there.
Yeah, absolutely.
So let's move on to our last subject, Evan, which is always a very sensitive one, but always hugely enjoyable, I think, in terms of some of the comments we get and those sort of things. But let's talk about fees within advisor firms, but also fees across the value chain. What are you actually seeing from a fees perspective, and what are the trends in that area, Evan?
Sure. And so I'll compare mainly to the UK here, because I think a lot of the things have played out. It's actually a very similar structure, value chain, same participants, way of charging is more similar and all of that. I'll end with advisor, so the more positive bit of the chain anyway. So in terms of the trends, so I'll end with advisor, but so generally the whole value chain, it's under pressure. It's under pressure. We're an affordability challenge time. It shouldn't be surprising that people are starting to look at where can we squeeze things. So focus on value for money. The focus on value for money also means less tolerance for price premiums. So we used to see all these justifications, which probably made a lot of sense, right? Which is actually, I'm willing to pay 20 bips more for this because of that, right? We're getting less of that now. We're getting more of one where I select you because of that, extra bit, and that's why you're getting my business, and I still want you to be priced in line. The biggest pressure has been in asset management, to be frank. I think mainly just because it's linked to margins a bit, but generally we're finding the whole value chain is under pressure. Now, if I go into the advice fees bit, unless you got any questions on that kind of the rest of the chain.
No, we'll come back to that in a minute.
Sure. Oh, okay, sure. So, I mean, on the advice fees bit, we hear all kinds of reasons why the advice fees are going to come under pressure, but we think they're going to go up. And I think the reason, I'm not just saying it because you're outnumbered and there's more advisors on the call than anyone else in the value chain, but it's actually just so firstly, the UK's fees are higher and they've been increasing. So the UK average bips is higher than the SA average advice fee bips, and the UK numbers going up each year. And if anyone on the call wants the figures, we can share. But so that's interesting. We've seen it increase, and a big part of it's really just around the sophistication of the offering. So holistic, we talked all about that, right? Broader family piece, the bit around intergenerational wealth transfer, like all of that is a more sophisticated, high net worth proposition. And in the UK, that's tied to about a 10 bip higher advice fee. So even though it's more likely to be a higher net worth client, higher assets, it's also actually about a 10 bip higher fee. Somewhere in the mid 80s is what we're finding for holistic advisors. But also, that's if you take the value-led approach. But more practically, advisors' costs are going up. Regulatory costs, just the inefficiencies of dealing with clients. And fundamentally, advisors are going to have to make money. So if the costs go up, they're going to increase their fees, because the main reason why is that they've got the most kind of power in that value chain. They've got the relationship with the client. Now we find they consistently underestimate the strength of the relationship. They consistently overestimate the amount a consumer cares about the advice fee, or the extent the consumer knows what a BIP is. And so the longer term, just for numbers, the longer term projection that we've got, well, sorry, more like a midterm projection we've got for the SA market is 20 bips down overall, 10 bips up for the advice fee, which means 30 down for everyone else in the chain, and 10 up for the advisor. That's what we expect.
And so you're saying a 10 bip increase for the advisors there. What's the starting point? What's the average bip rate fee for advisors here?
It's good. It's a good point. So at the moment, we're getting a number like 60. So 60 for advisors in SA. Now, what's funny is people at 70 can't imagine the average of 60, and people at 40 can't imagine the average of 60. There is a variance. Actually, and interestingly, in South Africa already, the high net worth advisors are charging more than the 60, and it's actually the lower, wealth segments that are charging less, which is interesting. So they're charging less on smaller books. But 60 is average in SA right now, and it's somewhere in the 70s in UK, maybe 74 something. And again, as I say, holistic advisors in the UK, 80 something, mid 80s.
And that advice fee in the UK has really moved significantly since RDR came in. RDR came in 2012 there, of course. So you've seen, I think, a real growth in advisor fees as advisors have brought value to how they see themselves, and therefore how clients see them. Once an advisor sees value in themselves, the client sees value in them. Tell me, in your interviews, and I come across two types of advisors, and my team tell me this as well. We have two types of advisors. One type who focuses hugely on fees, and completely overestimate the importance of fees in the client's mind. I might get shouted at for saying that. And then there's another group who actually fees is not an issue. It barely ever gets talked about. Would you say there's that kind of polarity, if you like, between advisors when you interview them?
Yes, and I think it links to that confidence in the value proposition piece, because if you believe you're just a commoditized product and you're fundamentally, a commoditized product, and someone else, another advisor's another commoditized product, and then they're 5 bips cheaper than you're worried, and you think that's a threat to your business, which if the commoditized view is accurate, then that would be a threat. Whereas our view would be that anything that's got personal relationships is never commoditized. And this thing, this whole piece is just, well, maybe I'll be proven wrong in however many years, but we think that this is not something that's going to go direct, as I say, and the advisor relationship is critical. So already we're not in the commoditized space. And so I think the advisors that aren't worried about fees, look, firstly, they generally have the value chain under control. So you can't just not care about fees and then have your clients paying ridiculous rates. It's generally, I've got the chain under control, but I'm confident in my part of it, and I'm confident in my value proposition. And that's why a lot of what we've been talking about is ramping up the value proposition, because if you're confident in that bit, then the fees works itself out and the client's happy, and then, and it's harder to replace, right? Because one bit of what you do might be commoditized, but if you're doing a real, holistic, I keep forgetting that word is probably overused, but the whole holistic piece is harder to commoditize and bucket in, right? So yeah, I would agree with your view, and I'd say it's linked to the confidence in the proposition.
Yeah, and that comes back to all the things we were talking about earlier in terms of making sure you've segmented your client book, making sure you have different propositions, making sure multiple people are touching the client, all of that kind of stuff. It's much harder to start ramping up fees or to move those fees up if it's just, a one-to-one relationship, client and advisor. Would you agree?
Yeah, absolutely.
Perfect.
And so just maybe as an extension to that, that'll link in a few of our points, and this bit around there's a Warren Buffett quote, which is, in a hurricane, even a turkey can fly. And I think, look, the challenges, we talk net zero, there's no hurricane, there's barely any wind, right? You're going to have to fly on your own. But so I think that links to, if you really develop value proposition, you've got 3 bits that really compound nicely around the value of your business. Because firstly, if you're getting net inflows in a time when it's barely above net zero, if you're getting net inflows, your assets are growing ahead of the market. If you're confident in your holistic advice and the broader value proposition, you're charging higher bips as revenue on those assets that are also growing faster. And then the third piece is that if someone looks at your business, says that's a really well-run business that's got kind of a way of doing things and a safe business model, then we're going to pay a higher multiple on it. So you'll end up paying more multiple on revenue that's on a higher revenue that's on a higher asset base. And so that really compounds. So you get this piece really, it's not that easy, right? There's a lot of bullets and a lot of elements in there. But if you get that right, the value of the business grows due to this kind of compounding 3-variable piece, which is great.
Yeah, brilliantly linked together, Evan. Thank you for that. Now we've got just a few minutes at the end of our session to go through a few questions. So I've got one here from Sean. Sean, thank you so much for joining us today. Why is it that only 60% of clients have advisors in South Africa? Is it because trust is low in the industry, and has that perhaps been driven by bad behavior or problems with product providers, or what do you think about that?
It's a tough one. I'd have to get into the data to really be closer to it, because I expect the 60% is going to also link to certain segments, because often we talk with the advice gap, we'll assume it's a challenge where it's the people that don't have it, that don't want it, and that's a gap in their operating model. So I'm not saying we always assume that, but we might be saying that 40% are saying that they don't want an advisor, but it might just be the advisor saying I can't make money out of that 40% yet. So there's going to be a bit around life stage, even to personally, right, I'm largely still a direct consumer, but I know as soon as anything gets complicated, I'm going to go to an advisor, right? There's a limit to how much you can advise someone on my £100 in my investment account. So I think there's a point where people may not currently be advised that will actually look for advice when things get difficult. I think especially over COVID, you had a bunch of people thinking they could just pick stocks and do really well. And for a year, they thought it was true, and they would sit in that 40%. But again, as things start to get tougher, I think the trigger, advice is likely an absorbing state, right? Once you go for advice, you're likely to stick with it. And I think it's more so just what's going to be those triggers that pull the guys across. But look, it is tough. I can't comment without knowing the segments we're talking about in terms of that 60%. But yeah, I think a key part is around actually that trigger for consideration and thinking about the proposition for them.
Yeah, I agree. And it's also a challenge, I think, for advisors to try to get, and again, this comes to intergenerational relationships, trying to get or show the value of advice before there's an event. And an event often carries with it grief. And we all know when you're in grief, you make poor decisions anyway. So you kind of want to have that relationship before you get to that place. So how do you build that? And again, it comes to that farmer, entrepreneur, hunter type model. How are we going to do that? So I think there's all sorts of things that you can think about in terms of trying to get a relationship with the client before it's an event as such. Okay, so next question from Ben. Ben says, how do you measure the DFM usage? What do you do to do that? Is it assets? Is it number of DFMs, people that use DFMs? Like how do you, when you do your survey, how do you measure the DFM usage?
So a couple of ways. So the first is going to be penetration, is simply what percentage of advisors we speak to that are in a relevant segment for this. So the kind of the one or smaller IFA style businesses. It'll depend on the networks and agencies. Will be a different model for some different ones. So, but it's what percentage of them say I have a DFM is the starting point. And by the way, it's overwhelmingly one DFM, even long-term view. I know because there's some exceptions, but generally it's overwhelmingly one. So penetration is one way we measure it. The other, and it's now the majority of IFAs that we speak to, but we do interview a potentially slightly skewed sample. The next way we'll measure it is what percentage of the assets are currently controlled by them, and that links to this piece around conversion we mentioned earlier. So the percentage of assets controlled will be somewhere in the kind of 35%. I've got the exact figure somewhere, whereas it's 50-something% of relationships in our sample. So those are the real two. Is there a relationship, and how much of the real money out there is controlled by the DFMs?
Okay, brilliant. Thank you for that. So this one comes from someone who has remained anonymous, but I think it's a very interesting question. Have you come across firms across different markets who use technology in any way for succession planning? What sorts of tech do they use? For example, are they digitizing their client records or managing client relationships better? I mean, I can think of all sorts of ways in which I've seen it as well, but I'm interested to understand what you've seen. And of course, there's that word robo advice for the tail and things like that. What have you seen? What have you seen in the tech area to help manage the value chain of segments of clients that you have.
So the bit I like about that is when we started going into tech is you were listing out the things that I think are the practical next steps for advisors, especially because it's the same thing when we had clients in the UK talking about big data. And we were like, guys, we're still working with small data and not on top of it yet, right? So it's the same thing here with AI, right? It is exciting, but starting with CRM systems and starting with like, what are your back office systems in general, and is everything in there? And so I guess the question started on succession, and I was a bit worried because I don't know of anything specific to succession planning. But actually, the bits around having your CRM, having the segmentation in there, how does that link into advice process? What is the advice process? Is it actually articulated through tech, right? And how does that link into the fund? What is your reporting model? I think the simplest back office tech piece is the most important part, whether it's thinking about things, the exciting bits of tech later, or if it's thinking about succession planning. But fundamentally, I think that's where lowest hanging fruit is in there. Not to say it's easy.
I completely agree, Evan, and I'm afraid it's boring, really. But actually, the best places where tech can be used is to automate the boring, repetitive processes that you have to do, whatever they are. So, it's all very well thinking about robo advice for the tail, and there are some really great, exciting stuff in there. But actually, just to automate those repetitive tasks that people have to do day in and out, that is going to save you time, which in turn will save you money. Evan, we've had a really fascinating discussion, I think, for an hour. Thank you very, very much. I've certainly learned a lot. I hope our advisors and our clients listening have also learned a lot as well. Just a note that if you'd like to get involved in Evan's survey next year, please do drop him a note. The email address is evan.bars, BAARS, @nmg-group.com. Have I said that right, Evan?
Yes, that's correct. I've seen a couple of emails come through actually, so it looks some have found my. So it's great. I'm looking forward to.
As always, multitasking, fantastic. Thank you very much, Evan. Really appreciate your time this morning. Dialing in from Australia, it's probably close to midnight where you are. So thank you very much.
I'm on Perth. It's 4 p.m. It's fine.
That's okay. You look fresh as a daisy as ever. So thank you very much for joining me, and thank you to our advisors for joining us online as well. So thanks very much.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.